Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, September 8th, 2022. What I'm going to do here is update on the equity markets. Really no change in my outlook, but obviously some things to watch. Never become complacent, especially in a bear market. Things tend to move fast, and reversals can come out of nowhere. But what I'm going to do here is we'll start out on the longest term time frame, work our way down to the shortest term time frames on the indexes. I won't spend too much time because I've gotten a lot of charts out to you today to look, and if any of those levels change or my outlook, I'll certainly convey that or get that out to you as soon as possible. The other things I'll update, quick update on natural gas, crude oil, precious metals, and maybe time permitting lumber at the end. But I'll just kind of breeze through all those because those are things I've gotten charts out to you and covered in videos recently, and really no change since the last updates. This is the biggest picture, and I from time to time I try to make a point to loop back to this. Always new members coming in the site. Plus, it's worth reiterating. If I don't keep on this and remember to revisit the longer term charts, sometimes you can get tied up, what I call tied up in the world of the intraday charts, the short term charts, and then you miss the big picture, and then you can get on the wrong side of the trade there, especially getting too comfortable with a bear market rally if indeed that's what we're still in. So, all right, what you have on here, you can see there have been in recent decades, going all the way back into the late 80s, early 90s, there's been three primary bull markets. That big one back in early 90s up to the March of 2000s, when technically that's when it popped, the dot-com bubble. Started out as a strong bull market and just almost went parabolic there at the end. Then you had a bull market, and that was, by the way, the Nasdaq dropped after that 84%. So it was a vicious bear. The bigger the bubble is blown, the harder it is once that bubble pops and swing drop. Then you had a bull market from '02 to '07 right there. Then the Great Recession, they called it, big bear market. It doesn't look like much when you come back and look at a multi-decade view here, even using log scaling. You turn off the log scaling, it even distorts this more. But that was a 55% drop. But this just puts into perspective the bubble the Fed blew this time around with extreme easy money. This is where they went to the floor. This is where they started with zero interest rates back when the financial crisis hit in '08. And they figured, they took it up a little bit between then and back, but they basically had rates, free money since then. They took it off the ground a little bit, but never really got away from either zero or super low rates, not to mention all the quantitative easing. So that's why we're probably looking at a pretty prolonged, in my opinion, a much larger bear market. They've only relatively recently, started to reverse course there, and the only reason they didn't do it sooner is because they figured they could just print money at will, and it wouldn't affect the inflation. Was a thing of the past, for whatever reason. I'm telling you what the Fed somehow managed, and they realized that wasn't true. Eventually there was a flashpoint, and that's what hit around the time COVID hit. So we all know where we're at today, and probably most of you, maybe some of you, heard Powell talk today, and nothing's changed. He's jawboning the markets down. As I said before, if he was really serious about nipping inflation in the bud, he'd do an inter-rate cut. That's never stopped the Fed before. But so what he's going to do, and as he's doing now, is since the yeah, his brief speech at Jackson Hole was just to try to jawbone the markets down, and they are going to hike at the next upcoming meeting. But right now it's priced in, baked in the cake. From what I understand, is a 75 basis point hike, another three-quarter. And so right now that's what the market's holding up with, and happy, okay with, let's just say. So if he does anything less than that, or does that, then sort of implies he's going to sit and watch for the time being. Market could rally quite a bit, but of course, if they don't like what he's selling, then it could drop too. All right, enough on that. Let me get to the charts here. So what you can see of those three bull markets, all followed by pretty powerful bear markets, 84, 55, and this one's only underway now. Forget about that number I told you. That question marks mean I expect more. they were all defined by fairly well nice and clean uptrend lines. This yellow uptrend line is the primary bull market uptrend line. This is my bull market uptrend line. The financial media in most of the world right now says that we're already in a bear market. I believe we are, but if you look at it this way, if you forget about that old antiquated 20% definition, you look at this chart and you say whatever this was. If I didn't tell you it was QQQ, if I told you it was some random commodity, you'd say, oh, that's in a strong bull market, and I want to buy it right now because it just pulled back to its bull market uptrend line. And by the way, this isn't just a random line. I've had it here, and it has a lot of reactions. And as I always say, the more reactions or pullback successful tests off a trend line, the more valid it is. And we've been testing it here recently. So that is, and again, I'm kind of spending some time on the long-term charts because every now and then I like to loop back there. We hit it back a couple months ago, bounced right there, and we're still above it. That was in June. That's when we reversed, went long, rallied, getting that bounce. That was with that tag of that trend line coincided with the third target on the weekly chart for QQQ. Rallied up, had a nice rally, and here we are. So we're close to that trend line again, right above it. Ultimately, I think it goes. It's just a matter of when does it go. And when it goes, again, this is like 401k, long-term stuff. Hey, am I going to start a new business kind of stuff? This is the takeaway I would get from this, and that is that sooner than later, all trend lines are broken sooner than later. And this is, of course, a la the Fed, probably go down in history as the biggest bull market there was, and such. The bear market that follows is probably going to be ugly, and it's probably going to be multi-year. But I'm not trying to be all doom and gloom. You know me. I'm just as happy trading bear market rallies as I am bull market rallies. Money is money, long, short, and it's not going to be a straight ride down. It hasn't been a straight ride down yet. So we'll get to the short-term charts in a second. The other thing I wanted to show you, other than the fact that we're still above that bull market uptrend line right now, and so you can't write this market off yet. Could be another test, and maybe we break it next year. Who knows? Or the year after. I think it'll come sooner, but again, we haven't, like I always say, support is support until it's broken. Now, let's turn off all the lines there. So I showed you those bull market uptrend lines that were broken. And then just a quick revisit of what has to be my favorite, or one of at least favorite indicators on the longest term charts. That's 20-month period exponential moving average. I give it a 10 on the scale 1 to 10 for both effectiveness combined with simplicity. It's that easy. You just look at the index, and it works on the S&P 500 just as well. And when it's above it, you're in a bull trend. Not only that, when you get pullbacks to it, the line acts as support. And you buy those pullbacks, and this is how you can micromanage your 401k or a swing or a trend trader. But then when you get a close, it's a monthly chart, so you have to wait for a monthly close, not an intra-month peak. You zoom in real tight, you'll see little dips below. Those are the candlestick wicks or tails down below. That just means intra-month broken. You need to see a solid monthly close, like you got it right there early on in the bull market. Might have been 6-8 months later, but price wise it was right off the top, and that said, hey, get out of your 401ks, get out of stocks, start shorting, and don't get back in the market until you regain that 20-month, which you did here. So again, it is literally, if you don't ever want to active trade, you don't want to swing trade, you're here to help you figure out your 401k long-term stuff. This is it. Just use this until it stops working. I do like to use, obviously, other indicators. The more you can use, the better off you're going to be, because even though this has a great track record, one day it may prove to all of a sudden stop working with a lot of whipsaws. But there's the great bear market in 08. There's your confirming candle right there after it had taken it out. They actually had one early on in the bear market. You'd have to zoom in and you do it yourself, but put this chart up. Make sure to use log scaling, which I have here, and then you can see. So there it is, said get back in the market, and all along, all these dips, all these pullbacks, told you, hey, as ugly as it's going to get. This trend indicator never told you you're in a bear market. It just said, hey, ugly drop, ugly corrections along the way. They were called and labeled bear markets, such as that 36% drop in the S&P when COVID hit, 28 or something, closer to 30 in the NASDAQ. But you can see, worked like a champ. There's the monthly candle. Big intra-month dip, only to rally back and close right above the 20-month. There was an intramonth dip, but green means you close well above it. You exploded off it, and that's it. So by this metric, we are in a bear market, and I've maintained and continue to maintain. And just like I said, when you break it, just like you buy pullbacks to support, when you break it, you sell or short or get out of your longs if you missed it and you were a non-believer that we were going down before in your 401k, but then you had a great opportunity, and that coincided when we back tested it with my upper bounce targets from the rally we caught off the close. So that's it. That says we're in a bear market, but you can't just short everything and throw away the key yet until that line drops. To me, it's worth being out of 401k money, stocks, if you don't have the opportunity to act, trade in and out with trading restrictions and all that, simply because we're below that 20-month. So that's that. Okay, enough on that. Weekly chart, again, recap. Hit third target to the button, reversed, closed last of the short positions there, went long, rallied right up to the bounce target zone. Then went back, swing wise, trend wise, short again, broke the trend line, and here we are today. And now the $1,000,000 question, which we're going to get to in a second: are we going to just keep on going down and hit my fourth and what I call initial final bear market target, if that makes any sense? And that just means we'll have taken out, I should say, we'll have taken out the long-term trend line. That's not it there. This is just my weekly uptrend line right there, an alternative trend line I have. I'm really targeting this price support level around 235. But that's going to take us down, and if we close the month there and we close below that 20-month EMA, a solid close, then yeah, at that point, maybe there's something else, and maybe I may not be looking to go long for a big rally there. We'll cross that bridge when we come to it. Really, I'm kind of almost getting ahead of myself here. What may happen, how it looks, but I do believe we're going to get there. I do believe we'll be there this year or next and latest, and then how things look at that time will determine whether it's time to start buying a lot of longs and getting back aggressively long in a 401k or keeping out of the market. Alrighty, now one more step down, go to the daily chart right here on QQQ, which is what I'm focused on in this video, obviously. Turn off all the lines, and we have that big support level, a lot of reactions in this level right here, and that's all we did. We ran up, from being long to, getting out of those longs and shorting here, expecting the drop. That's it. We overshot the uptrend line by just a hair, but we hit the almost perfectly the uptrend lines. We did perfectly on SPY, the S&P 500, and the Russell 2000 hit those primary uptrend lines, and then QQQ has fallen to this big support level here. So despite market was volatile today, first when Powell was talking this morning, we had a big sharp down, then they bought it up hard, and then they sold it again. It's just this is a playground for traders. This is where, at least my type of TA style, sometimes I can't get out of my own way, but this is where it shines. And that's because the fund managers and even a lot of individuals are running around like a chicken with their head cut off. They don't know which way to go because the fundamentals are so rapidly changing, and everyone's trying to predict what Powell's going to do and what rates are going to do. And this is when technical analysis really shines over fundamental analysis, because there's just no way for these analysts and fund managers most of them use fundamental analysis to try to determine where to buy Apple and how much to buy or what stocks to buy and what sectors, because again, things are changing. The fundamental landscape is changing so rapidly, and so this is where you can just bounce these levels off these the Qs. You can actively trade. There was that level 302 target, a resistance level. We hit it today. They sold it, and they stepped in right at the trend line, and now we already hit it once, so that's why I had an arrow going up. We'll probably now go through it and run on up and hit the downtrend line, the next target. So you can see the downtrend line right here. This is, of course, a 5-minute chart that I stepped down to. The same one I got out to you today, same one I got out to you yesterday, expecting the pullback. And there it is. So you watch this uptrend line. Obviously, a big breakthrough there would be bearish. It's not the end of the world because you have some decent support around 296.40. But right now, you can buy pullbacks to that trend line. And then the sellers are going to step in here, most likely that is, at the downtrend line. And so that's it. So far, so good. So from that, bounce down to the trend line, or the pullback to the trend line, we bounce another 1.5%. So this is active trading. Boom, boom, go long. Cover, sell longs, play a little pullback, get back in those longs. Or, like I said before, if you're a swing trader, forget about all that stuff. Your head's going to spin. As long as these charts are constructive and you've got the positive, aka bullish divergence here in the 60-minute chart, and at least this minimum target of the downtrend line, you want to stay long. And if that breaks out, that's resistance right there, about 303 price resistance and the downtrend line. So breakout of that would even most likely bring in more buyers. So I'm open to all possibilities. Let's just take it one or a few days at a time, and let's see if we can get up to that next target, and maybe take some profits on these longs as an active trader. Maybe even game a short pullback, and then we'll go from there. Indexes, focus on the hourly charts right here on the index ETFs. When I say indexes, I meant the index ETFs. This is NQ, 1 hour chart, 1 hour candles. Usually I'll show you a few months, but this is just 1 month, so we can really zoom in on that bullish falling wedge. That's really the catalyst. It's kept us long and buying pullbacks lately and breakouts above resistance. So we're working our way up. One thing I wanted to mention is, remember, a week or two ago, I had pointed out a smaller wedge that also had some divergences, positive divergence, and we had a breakout, and it was impulsive. And then we consolidated and we popped. This looks very similar, and certainly could play out that way. There's been a lot of selling pressure in the market lately. We are in a downtrend since we hit those my max bounce targets, a few weeks back. But here's the thing. Usually when all I see something, the same patterns usually don't repeat again. So that is possible. And I gave you the levels to watch. Watch these support levels. If they get taken out one after another, it's bearish. Just one alone, it's not an all line in the sand. Close all your longs, get heavy short. But each and every one, that's where maybe you want to consider stops on your long positions. Because remember, in a bear market, just as things start to look good, the selling can come in hard and fast. So don't get married to any one bias, long or short, really, because that's the other thing about it. Just as the reversals in the next leg down in a bear market are very, very powerful. Trust me, I've traded many of them, big corrections in bear markets. You do not want to stay long and just hope that we're going to get a big bounce, because they just don't let the trapped longs out in a bear market. Now, on the flip side, some of my most profitable and favorite long trades are in bear markets, because the rallies are just as powerful, because they're not only full of buyers that are stepping in to buy the dip because they think it's over, but it's also chock full of short sellers who are getting squeezed out. I heard today, and I can check it, but I didn't bother, that the AAII sentiment is through the roof, extremely bearish, but that's not the one that I go by. I used to, and I'll factor it in to an extent, but the big one's the put to call ratio, and I can just tell you guys without getting too long in this video, because I didn't cue that chart up in advance, that is to me by far the most reliable indicator, and we are nowhere near the spike in fear. I have extreme levels that have a extremely successful track record of identifying the end of major corrections in bear markets, and we're nowhere near that yet. So that's why I don't think it's over. That's why I'm trading right now long, but with one foot on the accelerator and one on the brake, ready to reverse if needed. Okay, I'm going to have to end up truncating this video. I don't know if you can hear the beeping behind me. I'm in the lightning capital of the United States here, Southwest Florida, and we just had a power went out. There's a storm around me going on. And that means I'm on my UPS backup for the next few minutes, unless I want to go fire up the generator, which I'm not going to do now. So I'm going to wrap this video up here and stick to, oh, here we go. Power just came back on. All right, maybe I'll continue on and get those other things in. Sorry about that. All I wanted to say is, as of now, looks good. Yeah, some divergences keep building, and that could send us back down again. See a little divergence right there, but that divergence is much smaller than the big divergence down here. So I'm like I said, right now I'm still favoring the move up to that next target, by the way, on NQ here comes in at 12,473 roughly, and the downtrend line, if and when we get there soon, will come in with that. So in other words, you don't go like this, in one 60-minute candle. Markets are now closed for the day. Futures usually flatten out overnight. That's what they've been doing lately. Pick back up tomorrow. So whether we have another down or not, that's what I'm targeting near term right there. And they come in together, the downtrend line, roughly in 12,473. So that's NQ, ES, the S&P 500, just to kind of show you, to recap. Go back 3 months, and there's that primary uptrend line that I told you about that we hit. If this chart loads. Okay, there it is. There's your uptrend line. Doesn't get any better than that. Pull back to the trend line with a bullish falling wedge, and I'll take that shot 99 times out of 100, even in a bear market. Or I'm sorry, I'll take it 100 times out of 100. It won't always play out, but I just can't. It's just in my nature not to pass up on such a beautiful looking pattern. Pulse a breakout, everything getting really close to that 4018 target right there, but we're still a ways above the downtrend line. So we already had a reaction today. We effectively hit it, had a pullback. So I'm not sure if that counts, if you will, as the initial tag. But again, you still have the uptrend line, and I'm still favoring more upside for now. Just don't get married to it. Don't get married if we take out the uptrend line, especially if we take out those recent lows. But as of now, I think there's more upside coming here. Then the other one was RTY for small cap investors. Same thing, primary uptrend line, just a beautiful tag of that. This is, again, you see these multiple indexes coming down, both large and small caps, hitting very well defined uptrend lines off the lows with positive divergence and clean downtrend line, falling wedges. You just got to take those. But we're there. Boom, 1848. That's to the button right there. So kind of the takeaway here is both ES and RTY pretty much closed at resistance today. We already had a little pullback earlier in ES. Maybe we can power through there without another pullback. Maybe not. But either way, I don't think it'll be too much. And you have some support levels in which to buy if we do. And you still have my target. So swing traders, just sit tight. It's what I'd do if I wasn't an active trader. With stops in place. This level right here, a little bit below that 1800 level right there, really should hold up. You can see we maybe have a little bit of a inverse head and shoulders pattern forming right here, and maybe one more leg down like that, and then break out. But you can see either way, next target 1872 and or the uptrend line, whichever comes, well, they'll come in together. I really don't have much to add to gold that I didn't already get out to you today, so we'll just keep it short. There's that euro, and I gave you the chart. Again, I've covered that 101 times in the past over the years, the strong correlation. It's really an inverse correlation with gold and the dollar. That's really what it stems off of, and it's very simple if you don't understand fundamentally. It's because gold, at least the gold you and I are trading, whether it's GC gold futures, GLD, or you're going down to your local jeweler and trading in your gold for meltdown value or whatever, you're buying and selling that gold in US dollars. So when the US dollar rises and strong or rising in value, then it takes fewer dollars to buy an ounce of gold. When the dollar's falling, then it takes more dollars to buy an ounce of gold. So if you freeze supply and demand on gold, hold that constant, that simple fact there is immutable, the effect of a rising or a falling dollar. I use the Euro USD because the Euro is the biggest component in the dollar index. It's a clean chart to track. And also the Euro. So the Euro is basically an inverse chart of the dollar because it is the biggest component by far. 57.6%, I think it is, weighting in the dollar index. So this turns it into a positive correlation. So when this chart's bullish, gold's bullish. So you have a nice, clean, bullish falling wedge. You have a breakout and a successful backtest so far. Since that post I got out today, we bounced. So if that continues up to that target and those targets, then that's going to be bullish for gold. If that falls, net, that should be bearish and not good for gold and silver. But of course, you want to trade gold on its own merits as well. And you can see on the 60-minute chart, which I just flipped to, you've got positive divergence, a bullish falling wedge. And this is almost going to mirror the charts of the euro like I just showed you. I have some old lines here. I haven't cleaned up this chart. And then I could told you where more importantly, or as importantly, I'd say actually more importantly, especially for swing and trend traders, big positive divergence and at major long-term support. So again, and back testing that breakout of that downtrend line. So like I said, maybe a little brief crap out, and that's fine as long as it doesn't go too far down below that level. If it does, and you haven't bought gold yet, what you'd want to do on a breakdown is not necessarily take the breakdown. You could, it's a little speculative, but you wait for the reversal back above, because then at that point you have a bear trap. You have a break of support followed by a recovery, and that's what usually triggers the short covering on a false breakdown or bear trap. So and it may not happen, so that's why you can step in here, and if you've got a little room to add, you can always add if we do get that false breakdown bear trap scenario. Silver should follow gold, as should GDX. Oh yeah, and then crude and natural gas and all in this long video. Okay, I told you yesterday the breakdown was as good as it gets in crude, and so although there are some divergences both here on this daily chart, and you're going to get them on the 10 and 15 and 5-minute charts on the way down. It's really, I start getting concerned when I see it on the 60-minute charts, and I'll get to that in a second. But you want to use any bounces at this point, especially early on. If you share my view that we're going down here, you want to just short into a strength, and that's what we had. That's a daily chart. You can see it. So let me zoom in a little tighter. There it is. There's your breakdown candle yesterday. Perfect, as good as it gets. No guarantee it'll stick, but that's what you want to see. A little snapback today, and when you go down to the shorter term charts, like a 10-minute chart, you can see it wasn't just random. You had nice divergence. You had positive divergence on the 10-minute chart, and we popped. But so far, there, it's not going very far. If it got up here, great, 86. But I don't think you're going to get that far. I think you're going to get these little divergent lows, just like you had here. They're going to buy it. But then you're going to keep stair-stepping lower. That would be my guess. Now, again, if gold recovers 86 with conviction, oil, pretty bullish. And so you may want to have your stops. You would want to, in my opinion, somewhere not too far above there. But as of now, you can short into these rips. And there was even a previous reaction high right there that we stopped at so far. So I still think we're looking at more downside and a good amount of downside left to come in crude. And again, also note that how today we're kind of up, and then we got shot down, went up a little, and we closed. Where did we close on the QQQ? Let me see. QQQ closed only up 0.5%. It was up 0.5% is better than nothing, but that was also because we had that little relief rally in crude oil. Crude oil was up, closed up, 0.7% on USO today. Look at that back test of resistance. That's the golden shorting up. Are you kidding me? That's no guarantees it'll, and even if it went up to 71, still objective to short. And you get the 200-day moving averages. This is where I don't want to see it go, but I'll short that all day long, and I did. So then you have natural gas UNG, and I think I didn't cover this. Nothing goes down forever. It hit a support at 27.54, next support 26, but I still think we have a lot more to go. And we're just now early on in the breakdown on natural gas. 60-minute chart just looks as good as it could get. And we had that divergent high back here, a little wedge pattern, negative divergence, and we had a big drop right there. 45%, was that the 45% drop? Yeah, 45% drop. And it ended with a nice, clean downtrend line and positive divergence, and that was a catalyst for this rally. But then, most recently, we had another wedge, and there's our breakdown. There's my first support / target. There's the next one, 25.86. And then I think at minimum, we're coming down here to 22.91 and this uptrend line right there. So from where we're at today, if I'm right, no guarantees to that. We have at least another 17% downside in natural gas. Now, where I'm going with all that is, again, if that happens, that should be no guarantees, but if the drop in, another roughly 20% drop in nat gas and crude oil should be quite bullish for the equity markets for the reasons I said before. In itself, it's bullish. It's an abatement in inflationary forces, but then more importantly, everybody's hanging on everything the Fed does, and they're trying to anticipate what the Fed, because Powell has no clue what he's doing. Powell is jawbone in the markets right now. The Fed has always been reactive. They're kind of clueless, and they talk about all these predictions and what they think. They don't know what's going to happen. But what they're going to do is they're going to, as long as we have inflation, they're going to talk about and actually raise rates. And once you start seeing, especially like I said, when you go from the top here, if we get another 35, 45, maybe even 50% drop in natural gas, that's going to put a huge dent in the inflation numbers there, and it'll be deflationary, but at least allow for the Fed to ease off. And same thing with crude oil. So we'll track that. Like I said, as of now, the charts look like that's the most likely scenario. And if it does, then again, that will affect how long I might stay bullish and long equities. And if this you correction peters out and we start going up and taking out resistance levels, well, then we could get that final thrust down in the stock market and hit those next downside targets I have on the weekly chart of QQQ. But as of now, this is what I'm looking for: more downside in natural gas, more downside in crude oil, bullish and long precious metals and miners, and for the time being, bullish and long equities. If anything changes, I'll let you know. And let's go ahead and wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great evening.